Hi, and welcome to Random Rogers Big Picture for the week of May 3rd. Yeah, May 3rd, 2009. A couple of things on the agenda this week. One is a segment that came up on CNBC about managed futures, and then also some ETF closings. So, first up, the managed futures. It was an interesting segment. For some reason, neither guest was willing to name names. I don't even remember who the guests were, and it doesn't even matter. But they were talking about extolling the virtues of managed futures, which really is like the Ridex fund that I've been writing about for a couple of years now. There's an ETN that does something similar, and Claymore is going to be having an ETF that also does something similar. This is a fantastic space. I wrote about the Ridex Mutual Fund when it first listed in 2007. Somehow, I just gravitated to it right away and felt that it would be a useful product, to have in moderation, of course, but a useful product in building a diversified portfolio. And for the most part, that has been the case. It's had a couple of periods where it did drift down some, and this maybe is one of them now, which, that goes with the territory, but the market's up a ton in the last couple of, or not quite 2 months, last month and a half. Actually, no, I guess it's almost 2 months. The market's up a ton, and I don't necessarily own managed futures in the hopes it will be the best performing thing that I own. But the segment was kind of in the context of, hey, there's this new exposure that you can have for your portfolio. It reduces correlation, can outperform over the long term, all of that good stuff that very well could turn out to be true. I tend to believe that to be the case, but it's consistent with, I think, what I was talking about in a couple of places, both on the blog and also at Green Faucet during the week, about the time to find all these neat things is not after the stock market cuts in half. Now is the time to, it may be difficult, and I'm sticking to my discipline about the 200-day, but now is the time to be thinking anyway in terms of re-equitizing, equitizing into equities in whatever way you access equities, as opposed to thinking of ways to play defense. Just like I said, the horse is already out of the barn, or it's too late to shut the barn door. I think that was the title of my blog post on Thursday, and it is. It's too late. It's you should know about these things, and I'm going to maintain my tiny little bit of exposure that I've got. I've got 3%, or I target 3% in the Ridex fund, and then 2% in the Dover fund. A couple of other accounts from a while back have the Nakoma fund as an exposure, but I don't really exceed 5% in total. And I don't exceed 5% in really just about anything. But the point that I would make is, now is not the time to aggressively seek out how to get defensive. It's, just like I said, it's too late. Some reader, I think this was on the Street, I'm sorry, I misspoke, on the Seeking Alpha version of the Barn Door article, where some guy said, well, forget that, sell them all and reevaluate. And if you go read that comment, there's an awful lot of emotion that I think I was picking up in the post, in the guy's comment, which is, probably all the more reason why getting rid of all of them is just a bad idea. So as you see these things, and especially if we, are up here, kind of, not really, but then if we go back down again, there's going to be more and more of these segments about how to get defensive and how to protect your portfolio. The time to protect it was a year and a half ago, not now. It's, I can't stress that enough. And it's crucial. I'm not picking on CNBC for that, because, quite frankly, they need to, among other things, have people watch the program. And this is the stuff that the crowd wants to hear about. Well, you don't necessarily want to be with the crowd on this sort of thing. You want to be ahead of the crowd, like I tried to be when I first started writing about this thing in March of 2007. And then, I guess, as for clarity's sake, I let it prove itself before I put it in client accounts. I believe I added it in July of 2008 as an across-the-board holding. I'm talking about the RIDEX Mutual Fund. Learn about as much as you can. You don't need to rush into any of them. But now, in terms of what you do in the portfolio, I just can't imagine from here a whole lot of defense. From here is the right call, especially if you've taken none. Okay, next issue. I'm on distribution lists for just about every ETF company, interestingly enough, except iShares. Go figure. And so I got an email from PowerShares sometime on Friday morning, I'm pretty sure it was in the morning, saying that they were closing 19 of their exchange-traded funds. If you go to the PowerShares website and you click on products, you'll get, I'm pretty sure I'm describing that correctly, you'll get the entire product list. And they have a lot of funds. Some of them are huge funds, like they own, don't do that, Tater, they own the QQQQ, among others. And so this allows them the leeway that maybe some other companies don't have to, throw a lot of things at the wall, which I think is fantastic. Among things that they're closing, a lot of the RAFI sector funds are, I don't know if it's all 10 of the RAFI sectors or not, off the top I just don't remember, but they're closing a lot of them. RAFI is the research affiliate, something or other, which is Robert Arnott. So it's some sort of value-based, four-pronged value-based building up of the index. And so they're getting rid of those, and quite a few others didn't work out. I think it's tough to try and come into a space with funds that are just a remix of the same large cap, mid cap, and small cap indexes, and I guess in the case of PowerShares, even a different mix of the same sector products. That's very difficult to do. I was talking with someone at a very big firm that is interested in doing something, and I don't think this firm has figured out exactly what they're going to do. They've got one filing. I don't think they figured out exactly what they're going to do, but he was saying, what are we going to do? Have another Russell 2000 fund, or where's that effect? And I said, well, it's about finding new niches. I mentioned the ex-global shares are coming out with emerging market sector funds. There are other niches out there, like in fixed income and other things, but the same mix, or the same funds mix, same stocks mixed differently. There's going to be very little demand for that. If you read that Bonds Why Bother thing on Index Universe that I linked to on Green Faucet, and I kind of picked on it a little bit. But if you look at one of his conclusions, it's written by Robert Arnott, you'll see that he talks about there needs to be a whole lot more of fixed income type stuff, and I couldn't agree more. If the Treasury market is as fouled up, FUBAR, here we go, if it's as FUBAR as some of us think it is, then you're going to want foreign Treasury exposure, and I think the narrower that market can offer, meaning single country, the better off you're going to be, and maybe even for some countries, not just single country exposure, but maybe different maturities in those countries, or at least provide a way for U.S.-based investors to access those funds to the extent they exist in other countries. Either way, that would be a huge plus, and hopefully we see that happen. All right, I'm out of time. I'm going to run out of time. Have a great week.